Hi, my name is Paul, and in this video, I'm going to be covering MTY Food Group's 2022 fourth quarter financial results and conference call. And afterwards, I'll briefly go over how I'm valuing the stock. But before any of that, I want to quickly go through what I'm expecting out of this quarter. And all of my expectations are pulled directly from my personal notes, which were written beforehand. So if any of my expectations don't fully line up with what comes out later on in the report, this is why. Now, really quickly, for anyone who might have clicked on this video not knowing anything about MTY Food Group, MTY Food Group is a Canadian company that trades on the Toronto Stock Exchange under the ticker symbol MTY. The company owns over 80 different fast food and casual dining restaurant brands that operate in the US, Canada, and abroad. MTY's main business model involves franchising out these restaurant brands. However, the company also directly operates a small portion of particularly profitable locations. And in recent years, the company has also begun offering grocery and retail products centered around its more popular restaurant banners. Getting into my expectations for the quarter, first off, we'd probably be looking at some real problems if revenues weren't up, since this is the first quarter where there will be partial contribution from the recent acquisition of Barbecue Holdings. However, the other major recent acquisition, Wetzel's Pretzels, technically happened shortly after the quarter's end, and so none of their operating numbers should show up in the quarterly financial metrics. Even still, the Barbecue Holdings acquisition will probably end up drastically skewing almost all of the usual metrics, so a lot of what we see will have to be adjusted accordingly. That said, I am expecting to get an update on the strategy of franchising out the Barbecue Holdings brands, and I'm also expecting the management to speak a little bit more in depth about the Wetzel's Pretzels acquisition, especially since it was previously a private company, which barred investors like myself from looking into its financial history to try and glean just how expensive or cheap the price paid for the deal actually was. Next, I already practically know that debt levels are going to be significantly higher, so I really want to take a look at the interest expenses and liquidity to make sure that things aren't getting out of control. This quarter, I'm also expecting to get an explanation of why the retail and grocery product offerings have been declining over the past few quarters. Now, I am expecting free cash flows to be somewhat impacted by interest rate hikes and one-time operating expense costs associated with the Wetzel's Pretzels acquisition. So there will probably be a little bit of a delay before we get to see that bump up in free cash flow coming from the operating performance of the acquisitions. As far as capital allocation goes, we already got a huge dividend hike earlier on this quarter. Plus, there's the previously mentioned expected higher debt levels that probably will have dissuaded the company from repurchasing any shares within the quarter. So I'd be pretty surprised to see that happen, and there almost certainly will not be another acquisition anytime soon. But if there was ever a company who could find a way to make another acquisition, MTY probably would be that company. That said, I'm only joking. I'd be very shocked if there was any sizable acquisition that happened this quarter. And last up, I'm expecting to get an update on the delays on new store constructions, which were expected to continue to impact net location openings this quarter, but were also expected to subside at some point in the near future. Now, I'm going to be going through the management discussion and analysis version of the report, which is only available on Cedar.com as opposed to the standard report that's posted on MTY's website. And this is just because the MD&A report gives additional explanations and context for what caused the numbers to turn out the way that they did. Anyway, jumping right into it, we can almost immediately notice the impact that the acquisitions had on revenues, which for the fourth quarter were up a monstrous 65%. Breaking these numbers down, we can clearly see that this did not come from Canada's comparatively meager 20% growth rate, but instead came from the US and international portion of the business, which showed a 120% increase when compared to Q4 of 2021. Looking here, we can see that the increase came mostly from the corporate stores segment, which experienced a growth rate of 688%. And this, of course, is highlighted in red because it clearly is not organic growth. Instead, this was noted as having come from the Barbecue Holdings acquisition, which added 103 corporate stores to MTY's portfolio. And quickly popping over to the locations, you can see that this has more than tripled the total US corporate store count. Now, heading back over to the revenues, here you can see that even on the Canadian side of things, we haven't really been given an accurate picture of the organic revenues growth since the acquisition did have a $1 million positive impact on franchise locations. And there was also a positive impact from the previously recorded joint venture. And this is something that has been going on in past reports, but I haven't really talked about it yet. So I figured that this time I'd touch on the fact that when accounting for a joint venture's gains, those are going to be marked down separately from the revenues. But MTY has since taken control of the venture and is thus required to mark these gains down as revenues instead, which has artificially boosted numbers by about $4.3 million in Canada this year. That said, we can still see that the food processing and distribution segment had organic growth of 22%, since it was not impacted by any abnormalities. Also, on the conference call, we learned that as of right now, the grocery products are mainly being sold in Eastern Canada, and that the projected runway for future expansion is exceptionally large. However, the future is expected to be a little bit lumpy, since the market for their products do tend to be cyclical in nature. In addition to that relatively good news, it was also all but confirmed that the grocery collection website is not indicative of the retail products that are available, since this screenshot was taken shortly after the quarter's end on November 30th, and it shows 158 products on offer. Meanwhile, the report shows that there were 183 products on offer, which is actually a slight increase. So I'm assuming that the grocery collection website only tracks specific brands or geographies or something along those lines. While revenues were up across the board, unfortunately, so were the operating expenses, and they were similarly impacted by the acquisition, showing an 86% increase, which again mainly came from the US and more specifically, the much higher number of corporate stores. As far as Canada's 22% increase in OPEX in the fourth quarter, almost half of this was considered to be recurring controllable costs, which I'll get into a little bit later. But some of this was due to government wage subsidies that artificially lowered Q4 of 2021's expenses. Now, there were also some other one-time expenses that made this quarter look a little bit worse. Obviously, the acquisition costs would be one of these, but also there was the loss recorded due to the change in control from the prior joint venture, as well as an impairment on intangible assets, which, as I understand it, was the result of lower fair market leasing costs relative to what MTY actually paid for their leases. None of which is necessarily bad news, nor are they guaranteed to happen in future quarters. So this quarter's big question is, how is expense growth going to affect profitability? And the answer to this is, honestly, things weren't that bad. Free cash flows per share were only slightly down compared to Q4 of 2021, and considering the acquisition costs and other abnormalities, I was expecting to see much worse. That said, the free cash flow does not include interest expenses, so let's quickly take a look at the debts and then factor in their impact on the profits. Here we can see that the long-term debt is way up, with the majority of it contained within this $550 million chunk set to mature within the next 2 to 3 years. That's a lot of money, but things are actually even worse than that, since all of this $550 million is held within the company's revolving credit facility, which in MTY's case means that these loans are subject to variable interest rates. So when federal interest rates go up, as they have been recently, the interest rates on these loans also go up. So this is at least a little bit worrying, especially since I'm pretty sure that this figure does not include the $280 million that was paid for the Wetzel's Pretzels deal that closed after the quarter ended. That said, it was noted on the conference call that the current leveraged position will not hamper the management from seeking out additional quality acquisition opportunities. So at the very least, the management is highly confident that the free cash flows will be able to more than keep up with the debt payments. And we can see here that the amount of leverage that can be used within the revolver is capped at $900 million, of which about $409 million have already been drawn, plus the company has about $60 million in cash. But again, this does not include the Wetzel's Pretzels deal, which should come in at about $280 million. So theoretically, MTY could make another $250 million or so deal by using their allowances within the facility and the cash on hand. And on that note, there actually was another acquisition, this time of the brand Sauce Pizza and Wine, which is a pretty small one consisting of only 13 corporate locations, and MTY paid just shy of 15 million Canadian dollars for it. Now, we did get a little bit of additional color here on the conference call, where the management said that the acquisition will be immediately accretive to free cash flows, and it will present a strong opportunity for future franchising growth. So, not a big deal by any means, but nonetheless, it will tack on a little bit more debt. Moving along, as we can see here, the interest expenses on debt and long-term leases are expected to practically double starting in 2024, And again, this is before accounting for the Wetzel's Pretzels debt. However, free cash flows in the coming year should be higher than they ever have been, thanks to these acquisitions. And this year, the total free cash flow came in at over $132 million, which should already be able to cover the higher interest expenses by more than double. So, barring a lot of things all going wrong at the same time and persisting for quite some time, I don't think that MTY should have any issues paying down the debt, especially since there will be some time to chip away at the long-term leverage before those increased interest expenses start hitting in 2024. That said, there will clearly be some inherent interest expense related risks that should not be taken too lightly. As for the net income, this was likely the cause of the drop in share price, since EPS for the quarter came in at only 29 cents per share versus the $1 earned in Q4 of 2021. So, what caused this drop? Well, according to the report, it mostly had to do with the non-cash impairments due to the increasing federal interest rates that lowered the fair value of certain intangible assets, like the previously mentioned lease agreements. Additionally, there was an increase in interest paid on long-term debt and acquisition-related costs, which were slightly offset by the sale of some property, plant, and equipment, as well as a fair value gain on some of the financial liabilities. Now, to throw my own opinion in, I think that a lot of these non-cash expenses that are included in the net income do not tell the full story and are not indicative of real declines in the business's performance. This is why I prefer to look at free cash flow over net income. Unfortunately, there are other useful metrics that also paint a bit of a gloomier picture than was shown in the free cash flows. For instance, at first glance here, you might think that there was a positive resurgence in net locations, since the company improved both when compared to last quarter and Q4 of 2021. But if we subtract the 301 locations that were acquired, there were actually a significant number of stores that closed relative to the number that were opened in the period. And this, of course, is not good news. In fact, on the conference call, the CEO said that closures must decline in 2023 and that this quarter's restaurant closures exceeded projections. So, going forwards, focus on preserving the integrity of the current restaurant network is considered to be among management's top priorities. As far as capital allocation goes, there were absolutely no repurchases within the quarter. And I think that's probably a good thing, since the focus should definitely be on getting the debt down to lower levels, especially in the current higher interest rate environment. Plus, on the call, it was mentioned that the portion of free cash flow being used to pay out the recent dividend hike is expected to be within the normal historical range. Thankfully, in the call, paying down debt was noted alongside making future deals and optimizing existing franchisees' businesses as being the management's central points of focus. So we probably shouldn't be expecting any buybacks anytime soon, and there also probably won't be any dividend hikes until next year rolls around. Next, we did get a little bit of additional information on Wetzel's Pretzels, although it was nowhere near as much as I would have hoped for. Nevertheless, we learned that 329 of the brand's restaurants are franchised and that the remaining 38 were corporately owned. And that's pretty much it. Everything else we already knew beforehand, so I'd say that this was pretty disappointing, but we should still definitely learn more next quarter, since at that point Wetzel's Pretzels will actually be contributing to MTY's operations. And the last thing that there is to go over in the report is the future outlook. It's no secret that the company has been experiencing some economic challenges coming from inflation, supply chain disruptions and shortages, labor shortages, and federal interest rate hikes, which, on top of the expected future minimum wage increases, will likely further impact the short to medium term. So things are looking a little bit worrisome, but sales have returned back to pre-pandemic levels, and trends for the restaurants that have been slower to recover are looking promising. And because of this, the management believes that the network is well positioned to thrive in the future once some of the previously mentioned challenges have been mitigated or overcome. A bit of added information on the conference call was that despite the fact that MTY now has more corporate stores, the management is not currently looking to liquidate any of them because they are highly profitable. That said, the CEO did note that they are not looking to establish any new corporate locations because they consider MTY to be a franchisor at heart. In line with that notion, the CEO, Eric Lefebvre, did mention that MTY will be looking to sell the underperforming corporate stores or locations where it makes sense to do so. To end things on a bit of a positive note, it was claimed that Barbecue Holdings generated encouraging amounts of profit in a partial quarter that is traditionally seasonally softer for their brands. And this growth came despite MTY having adjusted menu prices higher, to which customers have responded positively with minimal impacts on traffic, which is a clear sign of brand strength in my opinion. So all in all, this quarter was pretty mixed, but I don't think we can get a clear idea of how things are going to go in the short to medium term, since a lot of the variables, like the floating interest payments and labor challenges, are linked to economic factors, which are out of the company's hands. And all of that is before considering that we don't really have the full scope of how the company is going to be performing with these new acquisitions. So there are probably too many unknown variables right now to try and pinpoint a fair price. That said, if we turn our focus to the very long term, I think that there's a strong likelihood that the headwinds currently facing MTY start to fade away, and that the company returns to strong free cash flow per share growth. Personally, I would normally consider a relatively fast-growing company like MTY to be conservatively valued at a price to free cash flow of somewhere around 15. Right now, the company is trading for a free cash flow multiple of around 12, but current economic circumstances are very different from what was normal in the past 15 or so years. However, a federal funds rate of around 5% has been historically normal since the end of the gold standard. So, depending on whether or not we revert back to the recent standard of lower interest rates, or whether we've already reverted back to the historical normal, heavily influences the amount that I'm going to be willing to pay for growth. Personally, I don't like to gamble on things turning out perfectly. So instead, I demand a reasonably large margin of safety when I invest to ensure that when things don't go the way that I'm planning, I still have some downside protection. The question is, does MTY provide that protection? Well, given that we know that the acquisitions are expected to be accretive to free cash flows, we know that the trailing numbers used to come up with the price to free cash flow of 12 is going to be at least slightly lower than what we should expect going forwards. How much smaller, I don't really know. So I think that around the $70 price range is probably where I would conservatively place the fair value for MTY stock, given the information that we currently have, which provides about an 8% margin of safety. That's pretty small, and obviously much worse than when I was buying in the 50s with a lower discount rate over the last year. As for what I'm planning on doing with the stock, well, if you watched my Morguard video, then you already know that my low cash position is keeping me from buying more shares of the REIT. And in my opinion, the REIT is much more heavily discounted than MTY. So I'm not really planning on buying any more MTY shares in my TD brokerage account anytime soon, at least not in the $60 range. That said, unless I find another company that's offering a better deal, I will still be taking advantage of the estimated 8% discount to fair value in my Wealthsimple Canadian stock portfolio, where I invest $100 every month and document everything here on the channel. Plus, while I do use a very conservative valuation model to ensure that I get good returns, I do not sell shares of quality long-term holdings at their conservatively estimated fair value. So unless we see MTY jump into unreasonably overvalued territory, or I find another company with very strong long-term perspectives that is unreasonably undervalued to a much greater extent, I will not be selling any of my shares in MTY. That said, all of this is just my opinion, and it is possible that I am incorrect in my analysis. So please make sure to do your own research and come to your own conclusions before making any investment decisions. I am not a financial advisor, and this video is not financial advice. This video was made specifically for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes to invest and share my opinions with others, and in doing so, I hope that I was able to provide you with something of value. And if you did enjoy this, then please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.